Have you ever looked at two companies, maybe in the same industry, like gold mining, and they seem, well, pretty similar on the surface, but you just get this feeling there's more to it. It can be kind of overwhelming trying to sort through all the info. Well, today, that's exactly what we're going to do. Cut through that noise. We're doing a deep dive, focusing on two specific gold exploration companies, Dakota Gold Corp, ticker DC, and U.S. Gold Corp, which is USAU.
Yeah, and our goal here is pretty straightforward. We want to get past just the raw numbers and the finance speak. We're aiming to pull out the key takeaways, really understand their strengths, their weaknesses. We've looked at financial summaries, ownership details, and a direct pros and cons list from our source material.
Exactly. It's not just about the stocks themselves, is it? It's about getting a feel for what makes these companies different. What do these metrics actually mean in practical terms? Okay, so let's maybe kick things off with a big one. Market capitalization. Everyone throws this term around. What does it actually tell us about how the market, sort of, sees a company?
Right, market cap. It's essentially the market snapshot valuation, the total value of all the company's shares out there. And looking at the figures we pulled, there's a pretty significant difference. Dakota Gold Corp DC is sitting at about 145.27 million USD. US Gold Corp USAU is way higher, 427.76 million USD.
Wow, yeah, that's quite a gap.
It is, and our source explicitly lists higher market capitalization as a pro for USAU and, conversely, lower market capitalization as a con for DC. It often suggests, maybe more investor confidence or perhaps perceived larger potential in USAU's assets or plans.
Interesting. Okay, so that sets the scale. Now, what about the nuts and bolts of the balance sheet, assets, and liabilities? Our comparison source doesn't list every single number, but it gives us a clear view on how they stack up against each other, right?
That's right. The pros and cons section is quite direct here. For Dakota Gold, it highlights lower liabilities. That's a plus. For U.S. Gold Corp, it notes higher liabilities. That's listed as a con.
And lower liabilities. For an exploration company, that sounds pretty important. Less debt pressure.
Definitely. Lower liabilities can mean less financial risk, maybe more flexibility. They might not be as reliant on borrowing cash to keep exploring. Higher liabilities, like with U.S. Gold, could imply they're using more leverage, which, can amplify gains, but also increases risk if things don't pan out.
Okay, let's unpack this a bit more, dig deeper into their financial health. What about things that show how well they're managing sort of day-to-day finances, like the current ratio?
Good point. The current ratio is key for short-term health. It measures if a company can cover its immediate bills with its current assets. Our source flags a higher current ratio as a pro for Dakota Gold.
Okay.
And a lower current ratio as a con for U.S. Gold Corp.
So a higher ratio means more breathing room, more liquidity.
Exactly. Better positioned to handle short-term obligations without, scrambling for cash.
Yeah.
Especially crucial when you're exploring and not yet generating revenue.
Right. That makes sense. Now, what about these per-share metrics? Total cash per share and book value per share. Can you break those down for us? What are they really showing?
Sure. Total cash per share is pretty much what it sounds like. How much cash the company holds for each share outstanding. Here, Dakota Gold comes up short. Lower total cash per share is a con. U.S. Gold Corp, on the other hand, has higher total cash per share, which is a pro.
Got it. And book value per share.
That's the company's net asset value. So assets minus liabilities divided by the number of shares. Kind of like the theoretical liquidation value per share. And again, the pattern holds. Dakota Gold, lower book value per share, a con. U.S. Gold Corp, higher book value per share, a pro.
So for investors looking at fundamentals.
Yeah, these per share numbers give you a sense of the tangible backing or the immediate financial substance behind each share. Higher is often seen as more solid, fundamentally speaking.
And of course, we should probably just quickly mention a full analysis would usually dig into things like EBITDA, operating income, free cash flow too, even if our comparative source didn't focus on those specifics for this comparison. But let's shift gears a bit. This next part I find really interesting, ownership. Who actually holds the shares? Tell us about this idea of free float versus closely held shares.
Right, this definitely adds another layer. Free float is the percentage of shares available for the public to actually buy and sell on the market. Closely held shares are those locked up by insiders like management or big institutions, maybe strategic partners. They aren't typically trading day to day.
Okay, so how do our two companies compare here?
Well, Dakota Gold Corp has a free float of 67.57%. That means about a third of the shares, 32.43%, are closely held. Our source calls this a smaller free float.
A third held closely. Okay.
Then you look at U.S. Gold Corp.
Yeah.
It's almost all free float, 98.09%. Only about 1.91% is closely held. The source designates this as a stronger free float.
98%. That's a huge difference. So what are the potential implications? A smaller free float like Dakota's, does that mean management's more invested? Or is it harder for regular folks to trade?
That's a bit of both, really. A smaller free float with significant closely held shares can suggest strong insider confidence. Management has skin in the game. But the flip side is potentially lower liquidity. Fewer shares trading might mean wider bid-ask spreads, maybe more volatility if a large holder decides to sell.
And the stronger free float for U.S. gold.
That typically means better liquidity, easier trading for the average investor. It's just wider ownership. But, with only 2% closely held, some might wonder if insiders are as heavily aligned with shareholder interests long-term compared to a company with higher insider ownership. It's a trade-off.
Fascinating. Okay, we've covered a lot of ground: market cap, liabilities, ratios, ownership. Let's try to pull it all together now. Based on the pros and cons laid out in our source material, can you give us that balanced summary for each company? What does it all boil down to?
Absolutely. Let's synthesize. For Dakota Gold Corp DC, the pros identified are lower liabilities and a higher current ratio, good financial prudence, good short-term liquidity. The cons, however, are lower market capitalization, that smaller free float we just discussed at 67.57%, lower total cash per share, and lower book value per share.
Okay, so financially cautious maybe, but smaller scale and perhaps less tangible value per share right now.
That's a fair summary based on these points. Now, for U.S. Gold Corp USAU, the pros are pretty much the mirror image. Higher market capitalization, stronger free float, 98.09%, higher total cash per share, and higher book value per share. Bigger scale, more cash, higher book value. But the cons are higher liabilities and a lower current ratio. So potentially more financial risk there, less immediate liquidity buffer.
It really highlights how there's no single better company here, does it?
Exactly. What's really fascinating is how these profiles paint different pictures. Neither is universally superior. It really depends on what you, as an investor or just an observer, prioritize. Is it lower risk and financial stability like Dakota seems to offer in some ways? Or is it the larger scale, higher cash reserves, and market perception of U.S. gold, even with its higher debt and lower current ratio? You have to weigh those trade-offs.
We've certainly taken these two companies apart today, looking beyond the surface. We unpacked the financials, the ownership structure for Dakota Gold and U.S. Gold, and really tried to distill what makes them distinct. It shows how valuable this kind of focused breakdown can be, doesn't it?
It really does. Getting a handle on these specific metrics, even just a few key ones, helps you quickly become more informed. You can start to see the underlying story without getting lost in every single line item of a financial report. It highlights the different strategies and risk profiles, even within a niche sector.
So it leaves you, the listener, with something to think about, given these contrasting profiles, the strengths and weaknesses we discussed. If you were comparing two companies like this, what would you focus on? What criteria matter most to you? And maybe consider this. How might factors we didn't dive into today, like, say, specific drilling results, management track records, or even the price of gold itself change how you might view these pros and cons? Something to mull over.